US Treasuries Part 2. We're going to go over Canada and Great Britain, England. Here we see Canada. In red, we see the Canadian dollar. So the Canadian dollar is the numerator. So as this red line is increasing, that means Canadian dollar strength, US dollar weakness. And then in purple, we see the interest rate differential, which is the Canadian 10-year yield minus the US 10-year yield. And again, just real simply, when the Canadian 10-year yield is higher, you would expect capital to flow into Canada. So when this line goes up, you would expect money to flow into the Canadian dollar, pushing it higher. And we can see that kind of correlation here. Obviously, this is not a perfect one-to-one correlation, but hopefully you can see it's pretty close. And then in the white, we see the US 10-year yield. And we know this was the period right here that we're kind of most interested in, when it seemed like there was a lot of dollar weakness and bonds were getting sold pretty heavily. Remember, the yield on the bond is inverse to the value of the bond. So as bonds get dumped, the yield goes up. So what do we see? Kind of similar to China, Japan, and Europe. Around here on Wednesday, we see this divergence kind of here in the 10-year yield came down, bonds started to get bid a little bit, and then they moved higher into Thursday and into Friday. And that is the same period of time we noticed in the Chinese interest rate differential diverge from its currency, Japanese diverge from its currency, and the euro as well. So that period of time we see the Canadian dollar start to strengthen, even though their interest rate differential was trending down. And that was at the same period of time. Here, I'll draw a box to make it hopefully easier. So we see the interest rate differential should have, because it was falling, this should have pulled money out of the Canadian dollar, but the Canadian dollar strengthened. And just as a real simple kind of reminder, basically if you're a Canadian and you're holding dollars, more than likely you're not holding actual dollars, you're holding US Treasury bonds. You don't want to be in the dollar anymore, so you would sell those bonds, meaning bond price would go down, yield would go up. And then now you're left with dollars, but you don't want dollars, you want the Canadian dollar. So you're going to rotate out of dollars, you're going to sell dollars, buy Canadian dollar. When it comes to foreign currency, foreign exchange pairs, you're selling one to buy the other. So in this one, if you buy this, you would be buying Canadian dollars, selling USD. And that's what you would do if you're a Canadian and you didn't want to be in dollars anymore, is you would sell the dollars that you got for your treasuries. You would sell those and buy your local currency, which is the Canadian dollar. So this, again, it does look like there was some degree of Canadian selling in particular. It's kind of the same story we saw with China, Japan, and Europe. Let's look at Great Britain. Here's Great Britain. Same thing, US 10-year yield is in white, and the British pound, US dollar, is in red. So remember, pound is the numerator, so if this line is going up, that means pound strength. Purple line is the interest rate differential between the British 10-year gilt and the US 10-year yield. And again, you can see pretty good correlation between the interest rate differential and the currency. Like I keep saying, this is not perfect. It's not a one-to-one, but it is an interesting way to maybe get to the bottom of what was going on. People are certainly still talking about it. And again, the same period of time, early Thursday, where the 10-year bond was getting sold really hard and the yield was rising. That same period of time is when we notice the British pound diverge from its interest rate differential. We see the interest rate differential, just like in Canada, moved lower here, but the pound strengthened. So again, if you're, a Brit and you hold dollars, quote unquote, you're more likely holding those dollars in the form of a dollar-denominated treasury bond. If you don't want to be in dollars anymore, you would sell that treasury bond. You would receive dollars for that treasury bond, but you don't want to be in dollars. You want to be in your local currency. So you would sell the pound, buy the dollar, or put another way, in the form of this, you would buy this pair. You would buy the pound USD, because you'd be buying the numerator and selling the denominator. And sure enough, this period of time, same period of time, early Thursday morning. So this would have been, I believe they're 9 hours ahead of me. So that would have been 9 a.m. In London. And yeah, we see the yield moved higher. A lot of people were selling bonds, and the interest rate differential indicated, through that period of time, it actually fell. So you'd have expected money to actually flow into the dollar, but it didn't. It flowed out of the dollar and into the pound, and we see the pound strengthen pretty sharply here. So yeah, same thing as Japan, same thing as Canada, same thing as China and Europe writ large. We saw this notable divergence. All those currencies started to diverge from their interest rate differential, coinciding with the U.S. 10-year yield moving higher, aka the 10-year bond selling off and moving lower. And I'll show you this chart, which I'd put on Twitter. So ZB1 is the long bond futures contract. And then we'll invert the Treasury bond future, because remember, the yield is what drives capital into a currency, the yield. So by inverting this, we see, hopefully that looks familiar. This is an approximation of the 10-year yield, although the T bond is I think it's a 20 or 30 year, but you can see, going back a long time, there was this really tight correlation. So again, in white, that's the inverted bond. So basically the bond yield. And then in purple, we see the value of the dollar as measured by the Dixie. The Dixie is just one measure of the dollar's value. It heavily weights the euro. I think it's like 40 or 41%. So almost half of the basket of currencies that the DXY uses, almost half of it is the euro. But yeah, so we see this tight correlation, and this goes back here. We'll go back even further. So hopefully that correlation is pretty clear. You can see a very tight correlation. Every now and again, it'll diverge a little bit more. But in general, the treasury, the value of the bonds moves inversely to the value of the DXY, aka the dollar. So you could see that correlation, and it's, in my opinion, very tight. Every now and again, you'll get weird little idiosyncratic things, but in general, this thing tracks. The purple is DXY, and then the white is basically the treasury bond yield, which is inverse to the value of the bond. And you see here this huge, like, jaw divergence, where this thing just like opened up. That's not normal. That is not normally what you see. not in a developed market, in a current, global reserve currency holder issuer economy. This is not what you see. You don't see it diverge like that. And we went back pretty far. This goes back to 2022. We'll go back even farther. This is going back to COVID. COVID obviously had some idiosyncratic things going on, but and like I mentioned, every now and again you'll get generally the trend remains the same. You might just get an outsized move, like here, like back here in early 2021, we see the DXY was moving higher from this low here. But the bond yield was moving higher faster than, so every now and again, you'll get this kind of gap that kind of forms. And you can see around here too in 2023. Jeff Snyder, I think, actually pointed this out on his video about this. You can see a somewhat of a divergence, but you can tell that the trend remains the same. So like from here, they were both trending up. It's just that the bond yield was trending up more. So yeah, every now and again you'll get weird little idiosyncratic things, but in general these things track pretty tight. The value of a currency to its interest rate differential. But what we see is this thing widened significantly. They diverged very significantly, and it opened up. Now, Bessent, I also want to mention Bessent did an interview yesterday on Bloomberg where he was interviewed by Anne-Marie Hordern from Bloomberg, and she asked about foreign selling. And what he said was that they were not seeing that, and that the tick data, tick is what I had mentioned in the previous video. It's I forget what it stands for. It's put out by the Treasury Department, and it basically is like granular detail on each foreign country's holdings of U.S. Treasuries. And it's updated monthly, but it's not like the release for April is going to show February. It's not the prior month. There's must be some kind of processing time or something like that where you get the month before. So it's really kind of a 2-month lead, a 2-month lag. And he said, reviewing the tick data, we don't see any indication of foreign selling. And so my question for him, and I think in general, Bessent is I have kind words for him, but every now and again he'll say something that just kind of doesn't make sense. And with this particular situation, if foreigners were not selling and not rotating out of U.S. dollars, we wouldn't have seen dollar weakness as bonds were getting sold. As yields were rising, we would not see dollar weakness. And it's important to point out, like there's a difference between if the dollar had just kind of stayed flat, not really done much, and yields moved higher. It's kind of a lot less. I don't want to say concerning, but it's less notable if the currency just stays flat and yields are moving higher, because that happens. Time to time, one of these, the Dixie might move more than the bond yield. And that's how you get these kind of gaps forming. And that's totally normal. But like what you wouldn't see is a very sharp sell-off in the dollar as bonds are selling off. And so I'll show the candlestick chart for the dollar just to illustrate what I'm talking about. The dollar didn't just move a little bit, it moved a lot. And this is when we first noted this dynamic of capital rotation, repatriation, was back in late February, early March, when we saw these three big, I think that all three of them were 1% candles on the Dixie. This was when we first started to really kind of pound the table about capital repatriation. But yeah, see here on Thursday, we saw the dollar move down by 1.9%, by 2%. And that is a crazy move for a currency. You can see that most of these days are like 0.3, 0.2, 0.4. That's kind of a normal move for a currency within a day, is between, between flat and call it 0.5%, not what we saw on Thursday, which was 2%, and then followed up on Friday by 1.1%. So this move down in the dollar was definitely notable. It wasn't just kind of intraday. It's moving around, like he tried to kind of say. This was like a concerted selling of dollars. Uh, I just I don't know if he's trying to put a nice spin on it for some reason. He did say, that the U.S. The policy of the U.S. is still a strong dollar policy. He reiterated that, and he said that before. And we know Trump has spoken uh, about how much he values the reserve currency status, seemingly not understanding Triffin's dilemma and the fact that we are in kind of end stage Triffin's dilemma, and it's getting to a breaking point. But that's a different conversation. I guess I can do a video on that later. I've done multiple X posts on it. So if you're interested in maybe reading about Triffin's dilemma or resource curse, aka Dutch disease, you can find those on my X profile. But yeah, getting back to Bessent, this move down in the dollar on Thursday and Friday was not just intraday noise. This was a concerted selling of dollars, and the yield moved notably higher on Thursday and Friday. Again, sometimes you'll get weird small little divergences, but this was not one of those cases. The yield moved notably higher on Thursday and Friday. So on Thursday, we'll do the two day. Yeah, so this candle here is Thursday and Friday. And we can see that it moved higher by 17 basis points, which is significant. And intraday, counting the wick, counting the low to the high in those 2 days, is a 32 basis point range. So that is certainly notable as you're seeing this sharp sell off in the dollar. So again, the tick data that he is looking at is backward looking. It's from February, I believe. So it's certainly not what we saw last week. He's looking at older backdated data. And so yeah, I just, again, to the people that say that this move was not capital repatriation, I just ask, why was the dollar down so sharply? This is the 2-day candle for Thursday and Friday, and we can see it moved a total of 3% down. And if you take the range in those 2 days, 3.8%, so almost 4% in 2 days on the global reserve currency, on the DXY. So yeah, I understand that hedge funds were part of this. I understand that the basis trade unwinding was certainly part of this, but that kind of misses the point that there was also a portion of it which was capital rotating out of America, out of dollars. Capital repatriation is what they call that. So where money goes home. And for the longest time, we had set up our market as basically the world's piggy bank. We said, hey, we got the best capital markets. We will run a trade deficit with the rest of the world, meaning we buy more of your stuff than you buy of our stuff. And so we will send you dollars, which you really like. You love the dollar. It's the global reserve currency, so you need the dollar to buy oil and transact. A lot of commodities are denominated in dollars. Everyone wants to hold dollars, so we will run a trade deficit. The trade deficit is the way that we get the dollars out to you. It's basically the channel in which we get dollars to the rest of the world. You will receive those dollars, and because current account deficit must always be balanced by capital and financial account surplus, you will recycle those dollars into our capital markets. We have the best capital markets in the world. They're the most free. We don't ask a lot of questions. They perform really well, right? Like the dollar is constantly strengthening. So versus your native currency, you're performing well. And this is the trade weighted dollar, which I think is a better measure of the dollar's strength. The dollar is going to always go up, meaning just holding dollars alone, you're going to make money if you're a foreigner. But if you take those dollars and then you invest them into our amazing Nasdaq or S&P 500 or Nvidia, you'll also make money because those things go up too. This is called positive carry. And so we basically turned the US dollar into a funding currency, and I always point out that the U.S. dollar is really the carry trade. People talk about the yen carry trade, where people were borrowing in yen and investing in, Nasdaq or whatever. It's also happened with the peso, right? There are these carry trades that develop, but really the big carry trade is the dollar, and we've pretty clearly sent a message to the rest of the world that we don't want that dynamic anymore. We're trying to balance trade, meaning we're trying to reduce the number of dollars that we are exporting to the rest of the world. And this is a key point to consider. They have said they've multiple cabinet officials, part of the administration that are engaged in trade, have said that their goal is not to reduce the trade deficit, is not to just marginally improve the trade deficit. It is to eliminate the trade deficit, meaning balance trade. We import just as much as we export. Well, a lot of people seem to be missing the implication there, which is if we run balanced trade, the dollar cannot really be the global reserve currency. Now, again, this might actually be a great thing for the everyday American in the long term, but in the short term, short to intermediate term, that could cause that would have massive implications. If we start to balance trade, there would be not enough dollars. The rest of the world has tens, if not hundreds of trillions of dollars of dollar denominated debt. This is where the milkshake theory, dollar milkshake theory comes from. And they need dollars. They have these debts that are denominated in dollars. We know that M2 is much smaller than the size of the euro dollar market, 21.6 trillion. And we know that the size of the euro dollar market is at least 60, 70, 80 trillion. But once you start including derivatives and kind of more broad-based measure, people have estimated it to be hundreds of trillions. So, but there's only 21.6 trillion of actual real kind of official US dollars. So the theory behind the milkshake is there are all these dollar denominated debts in the euro dollar market, but only so many actual real dollars to service them. And that, the dollar would appreciate in a crisis. And I would just say I've always subscribed to that theory for the past, I don't know, 2-3 years. I've always thought that generally makes sense. The only thing I would say, and I pointed this out in the last couple of videos, but I just want people to consider a world where say you're a European, you're a German car maker, you have dollar denominated loans, dollar denominated debt, and your currency is the euro. Generally speaking, the dollar has been strengthening versus your currency, meaning say you take out $1 million loan, that $1 million is getting bigger, right? As the euro weakens, that debt is getting larger. So, and we know the dollar strength, kind of generally speaking, is up and to the right. So it is getting harder for you as that German car maker, that businessman, to service that $1 million loan. Well, now imagine that instead of you have wealth, capital, you have savings. Instead of putting that wealth and savings into the dollar denominated assets, you put it into gold. Here we see gold going back to like late 2022. This was really when it started to make the move here in kind of mid 23. But this shows gold. Now imagine you put your excess savings into gold. Well, gold is up versus the dollar. Remember, gold is just kind of short US dollars. Gold is up 60% since the beginning of 2024. So going back, the past 12 months, gold is up 60%. So if you started to invest in gold, that $1 million loan that you took out as a businessman that is denominated in dollars, that $1 million loan, if you're putting your savings in gold, is actually getting smaller and it's actually getting easier, less burdensome because gold is appreciating versus the dollar. Or put another way, the dollar is depreciating versus gold. And that gets me to kind of the last point that I wanted to make is, this move in gold is really worth keeping an eye on because the gold at the end of the day, gold is basically kind of a short fiat currency trade. If you are long gold, and it applies to Bitcoin too, any kind of scarce asset like that. Um, if you are long gold or long Bitcoin, you are essentially short US dollars. You are short fiat at the very least. And so when you see gold moving this high, this rapidly, I mean, a 60% move in 12 months for gold is not supposed to move that big. When gold moves that big, something that the market is sniffing some kind of major problem out. And I think this might be a better way to illustrate what I'm trying to get at, which is this is the value of the dollar versus gold. This is just the inverted gold price. And you can see that this thing is like a waterfall over the past 12 months. This is just insane. And so, I always point out that many people many normal Americans don't realize, but in a lot of ways, their dollar has already been devalued by 60% in the past 12 months because of this move in gold, which is really kind of the neutral measuring stick against which fiat currencies are measured. And so this is something to keep an eye on. Gold is up again today, making another move probably towards the all-time high. We'll see. Yeah, about to make a new all-time high, probably with like 0.2% away from a new all-time high. And it had sold off in that kind of deleveraging, that broad-based deleveraging that started to occur after Liberation Day. I'll go to the daily. But this move, it bounced really hard. We said actually on I think it was on Monday, we said, it looks like maybe a good entry point. We kind of expected it to maybe move a little bit lower, but this thing just rocketed higher. It was up 3.3% the next day on Wednesday. And then on Thursday, it was up 3%. And then on Friday, it was up 2%. So for gold, that is notable. The gold market is trying to send a warning about fiat currencies, about debt sustainability and fiscal issues. And so I would recommend that people keep an eye on gold. And then I will go over one last thing, the MOVE index, which we've been talking about a lot. The MOVE index is remaining elevated, and anything over 130 is basically that's when the yellow light starts to flash, according to the creator of the index. And so we're remaining up here above 130. And I don't know if this was a data error. Maybe someone in the comments can leave a comment. We saw this crazy move in the 3-month yield. So this was yesterday, last night for Pacific time. We saw the 3-month yield run up by like 52 basis points, basically 2 Fed hikes. two 25 basis point hikes, rate hikes. And we've seen this before. You can see going back that in early April, we had this spike, which was, I think, 51 basis points. So, yeah, about 52 basis points. Excluding these two big spikes, we see that it does this sometimes where it'll spike up. And remember, this is inverse, so this means the value of the bond is going down. The bond is getting sold, which is why the yield is moving higher. But yeah, like 10, 15 basis point spikes. And so, yeah, whether or not this is some kind of liquidity strain, some kind of fund might be trying to meet a margin call or is blowing up or something, I don't know. At first, I thought it was a data error because the 1 month and the 6 month yield were basically unchanged. So it didn't seem at first glance like it was probably anything notable. But then I started to kind of consider the context of the spike in April, which coincided with a SOFR Fed funds spread kind of getting starting to blow out a little bit. And started to kind of look at these other spikes that we've been having recently, which are much smaller. 10, 15 basis points, a lot different than 52. um, but yeah, this could be signs of liquidity stress. We've been noting the SOFR Fed funds spread as a good way to. We don't have access to SOFR spreads, swap spreads, and this is only updated once a day. So this is really the only thing I've been able to watch. But yeah, there's clearly been elevated stress in from a kind of financial firm uh, standpoint. So yeah, something to keep an eye on. If anyone knows the answer to why the 3 month spike like that, please let me know because in my opinion, it seemed pretty notable that it did that. The same thing goes for April. If anyone knows the actual cause, I'm not aware of what actually caused this. Like I said, it coincided with the SOFR Fed funds spread, and some kind of other measures of liquidity issues. I think high yield spreads were starting to move higher, credit spreads. But yeah, if anyone knows the answer to this question, please leave it in the comments. But yeah, anyways, hope that was helpful. Again, it's kind of to conclude, to summarize, uh, Canada, England, China, Japan, and Europe all had notable interest rate. Their currencies notably diverged from their interest rate differentials at the same time that the 10-year bond was selling off. So, was it coordinated? I have absolutely no idea. I don't think anyone really does, maybe 5 people in the world. But it all did seem to start in this kind of Wednesday, Thursday period of time. Now, it could be coincidental. It could be that, yes, they were all dumping treasuries, but they didn't coordinate. It wasn't a conspiracy. They just they all saw the same thing, which is kind of a hostility towards foreigners holding US dollars and dollar denominated assets. And they all just thought coincidentally at the same time to rotate out of dollars. That's 100% possible. But and of course, I keep saying basis trade unwind is certainly part of the move higher in rates, but it's not the only factor. The move in the dollar. I have not heard a good argument for why the dollar would move like that, and it's not capital repatriation. If someone knows of a good argument for why the dollar would move so sharply lower as yields were moving so much higher, please leave it in the comments. But I still haven't heard one, and that's normally not how it works, as we saw with the Dixie and the Treasury 10-year yield. So, anyways, hope that was helpful.